This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice.
Welcome to the Luxembourg Fundcast. Welcome back to the deep dive. Today we're plunging into a really core aspect of navigating the global financial landscape, especially Luxembourg. I mean, it's such a central place for sophisticated financial structuring, isn't it?
Absolutely. It's the hub for so many things.
Right. And if you're grappling with setting up deals or maybe advising clients or perhaps just trying to get a really solid handle on the structuring tools out there,
right,
the choice of vehicle is, it's paramount.
It really is. It dictates, everything that follows. Regulation, flexibility, cost, market access. The lot.
Exactly. Luxembourg offers this incredible depth of options, which is powerful, definitely.
But it also means the decision points can feel a bit overwhelming sometimes.
Right. So our mission in this deep dive, and we're using only the source material we have in front of us here,
You just sourced.
is to zero in on two of the most significant structuring tools and, try to cut through some of that noise.
Yeah.
The securitization vehicle, the SV.
And the alternative investment fund, the AIF.
Yeah.
Two big ones.
Two very big ones. And, on the surface, they might seem like just different types of containers, maybe for assets or capital.
Yeah, you could think that initially.
But as these sources make crystal clear, they are built on fundamentally different legal philosophies. They really serve distinct purposes.
That's the core of it, absolutely. Understanding that difference, that fundamental philosophical split.
Even as things change.
Yeah, even as the rules evolve and, the lines start to blur a bit, which they are. Understanding that core is still key. It's about knowing which tool fits which specific job. That's spot on. At its heart, as defined by the Securitisation Law, that's the law of 22 March 2004, an SV is essentially a vehicle for risk transformation.
Risk transformation.
Okay, yeah. It acquires or assumes risks, could be claims, assets, obligations, whatever, and then it finances that by issuing instruments whose value is linked back to those risks. Its whole design prioritizes contractual flexibility and statutory robustness, real solidity.
Right. So flexible but strong in its own way.
Yeah.
And the AIF.
The AIF, that's different. As defined by AIFMD, that's the Directive 2011-61 EU, brought into Luxembourg Law by the Law of 12, July 2013, an AIF is a collective investment undertaking.
Collective investment. That sounds more like a traditional fund concept.
It is. Its purpose is raising capital from investors, pooling it together.
To invest collectively.
Exactly. According to a defined policy, all for the benefit of those investors. And the whole AIF framework, it's very manager-centric. It focuses on investor protection, and it's geared towards facilitating market access, especially within Europe. That's a big driver.
Okay, so one is fundamentally about packaging and shifting risk, often with maybe minimal regulation.
Often, yes.
Yeah.
Not always, but often.
And the other is about pooling investor money under a supervised manager, really for collective investment purposes.
That's it. It sounds like more than just the slight difference, because it is. It's a whole different mindset behind why you'd use the vehicle in the first place.
Right. And we're going to unpack exactly what that means today. We'll dissect those core definitions, look at the legal forms they can take,
the different shapes they come in,
the incredible range of assets they can actually hold. That sounds fascinating.
It is very broad.
How they handle financing, management, and those critical features like compartmentalization for SVs.
Very powerful feature.
And that statutory bankruptcy remoteness. That sounds key for SVs too.
Crucial, especially the statutory part.
And then contrast that with the AIF side, the whole AIFM regulatory ecosystem, and of course that invaluable marketing passport.
Passport, yes. Hugely important for AIFs.
And we'll get into the practical stuff too,
Yeah.
right? What the sources say about the day-to-day realities.
Absolutely. We have to. The ecosystem of parties involved, who's actually around the table.
The service providers and all that.
Exactly. The structure of the documents, where the key points of negotiation usually are.
What people actually argue about.
Pretty much. And of course, the really crucial differences in timelines and costs. Those can be deal breakers.
For sure. And capital requirements too.
Yep, capital requirements as well. Ultimately, by digging into these specifics using just the source material,
Only the sources.
we want to illuminate those strategic factors, the things that really drive the decision, Why choose an SV over an AIF or, vice versa, based purely on what's in this comparative analysis?
Okay. And just to reiterate for everyone listening, this deep dive, it's about exploring and understanding the frameworks, the distinctions as they're laid out in the specific sources we've been given.
That's right. It's purely informational.
It's to help you get informed on this specific topic, not to provide any kind of financial or legal advice. You need your own advisors for that.
Definitely consult your professionals. Okay, let's dive in then.
Okay, let's start by really unpacking the securitization vehicle framework. The source material kicks off by highlighting the SV as a tool built for, well, tremendous flexibility and speed. And it notes the significant impact of that 2022 modernization law. Can you break down how the securitization law actually defines an SV and its core purpose?
Absolutely. The definition from the law of 22 March 2004 is really the foundation here. It states that a securitization is an operation where a securitization undertaking the SV essentially acquires or assumes risks.
Acquires or assumes risks. Okay.
Yeah. And those risks can be related to a really broad range of things. Could be claims, could be other assets, it could even be obligations owed by third parties. The key point is that the SV then finances this acquisition or assumption of risk. And it does that by issuing financial instruments.
Right, like notes or bonds.
Exactly, or other instruments now. And the value and the performance of these instruments are tied directly back to the risks that the SV has taken on. This is the real essence of risk transformation.
So you're taking a risk associated with something specific and turning it into a tradable financial product.
Precisely. You're transforming it. So it's not primarily about pooling money to invest in some broad strategy like you might see in a typical fund.
No, it sounds much more specific.
It is. It's about taking a specific underlying asset or a specific risk and repackaging its associated cash flows or maybe its exposures into securities or other financial instruments.
Right. And that core function risk transformation, that's the fundamental difference from an AIF.
That's what the source emphasizes, yes. The AIF, as we said, is defined as a vehicle for raising capital for collective investment. That philosophical difference, it's critical because it really underpins the entire regulatory approach for each of these structures. The SV is designed first and foremost as a financing and risk transfer tool.
Got it. That's clear. And the source mentions there are two main ways an SV can actually acquire these risks or assets, get its hands on them.
Yes. So sources detail the two primary methods. First up, there's true sale securitization.
True sale. That sounds straightforward.
It is perhaps the most intuitive form. The SV literally buys the assets. So think of a bank selling a portfolio of mortgages, maybe corporate loans, directly to an SV.
Oh.
The ownership of those assets actually transfers. It goes from the originator's balance sheet onto the SV's balance sheet.
So the originator gets cash.
Right. And the SV now owns the assets, it receives the cash flows coming off them, and it holds the associated risks. The assets are really off the originator's books.
Okay, truly sold. What's the second method?
The second method is synthetic securitization. Now here, the SV doesn't actually buy the underlying assets themselves.
Oh, so the assets stay put.
They stay with the originator on their balance sheet. Instead, the SV acquires the risk exposure associated with those assets. It does this usually through derivative instruments or guarantees.
Like a credit default swap.
Exactly. That's a classic example. The SV might sell a credit default swap that protects the originator against losses on a specific portfolio of loans. And the source is quite careful to clarify here that this activity, when it's done under the securitization law, is not considered regulated insurance business. That provides important legal certainty.
Ah, okay. So it's risk transfer via ownership in a true sale versus risk transfer via contract in a synthetic deal.
You've got it. Clear distinction.
Now, you mentioned a broad range of risks and assets earlier. Just how wide is this exceptionally wide array the source talks about? Is it really that flexible?
It is remarkably broad, yes. That's definitely one of the SV's defining characteristics. The framework is intentionally flexible, designed to accommodate all sorts of diverse transactions. So it includes the classic assets you often see in securitization, like commercial and residential mortgages, corporate loans, bonds.
The usual suspects.
The usual suspects. But it extends way beyond that. It can encompass things like trade receivables, insurance policy risks, even future revenue streams from things like intellectual property or royalty payments.
Wow, future revenues too.
Yes. And it also covers tangible assets, think real estate, aircraft, ships, big ticket items, and importantly, the 2022 law helpfully clarified that an SV can acquire and hold assets indirectly, so through subsidiary companies.
Okay, that adds another layer.
It does. Adds another layer of structural flexibility, especially for complex, multi-layered deals. Basically, if there's a definable risk or a reasonably predictable cash flow, it seems the SV framework is potentially capable of wrapping it. That's powerful.
It really is. Let's talk about structural flexibility then. The 2022 law modernized things here too, right? What legal forms can an SV take now?
It did, yes. Significantly enhanced the options. Before 2022, you primarily had corporate structures and the sort of amorphous securitization fund. Now, an SV can still be a fund, which is interesting because it doesn't have its own legal personality. It operates either as a co-ownership structure, a copropriété, or as a fiduciary estate, a patrimoine fiduciaire.
Right, the fund option remains.
It does. But the corporate options were greatly expanded. You still have the standard ones like the public limited company, that's the Société Anonyme, SA.
Right.
The private limited liability company, the Société à responsabilité limitée, or SAR.
The SARL.
The SARL, exactly. And the partnership limited by shares, the Société en commandite par action, or SCA. They also added the cooperative, organized as an SA, the simplified joint stock company, the Société par action simplifiée, SAS.
Okay, quite a few corporate types.
And this is crucial, the tax transparent partnership forms. These are the common limited partnership, the Société en commandite simple, SCS.
In the SCSP.
And the special limited partnership, the Société en commandite spéciale, the SCSP.
Yes.
Hold on a minute. SCS and SCSP. Aren't those the structures that private equity and private debt funds use all the time? The ones you see everywhere in the AIF world.
Exactly. And that's the absolute key strategic significance of this change, as the source highlights very clearly. Adding the SCS, and particularly the highly flexible SCSP, was a direct response to market demand.
The market wanted them for SVs, too.
Yes. Promoters and investors in alternative asset classes, they are very comfortable with these tax-transparent partnership structures. They know them, they like them. So this move, it was explicitly designed to allow the SV to compete more effectively with unregulated AIFs that had been using these partnership structures.
Ah, so it's direct competition. Absolutely. Now, you can potentially get the desired tax treatment and the familiar structural form of, say, an AIF SCST, but you can get it within the SV framework. And that potentially means avoiding the need for a regulated AIFM layer unless you actually choose to have one for other strategic reasons. It's a really clear point where the two frameworks start to converge, at least in terms of the available legal wrappers you can choose.
So it's not just adding more options, it's adding options that make the SV look structurally much more like its AIF cousin. It allows for more strategic overlap in how you might use them.
Precisely. That's a great way to put it. And the 2022 law also did something for the securitization fund structure. It now requires it to be registered with the Luxembourg Trade and Companies Register, the RCS.
Okay, so more transparency for the fund form too.
Exactly. Adds a layer of transparency for a structure that doesn't have its own legal personality.
What about financing flexibility? That also got an upgrade in 2022.
Yes, another area of significant modernization. The law basically broadened the range of instruments an SV can issue to finance its acquisition of risks. It replaced the slightly narrower term securities with the much broader term financial instruments.
Okay.
And it explicitly cross-references the Luxembourg financial collateral law. This gives much greater certainty for using various types of instruments, including, importantly, instruments governed by foreign law. The source mentions German Schuldschein as an example.
Right, so more flexibility in what the SV can issue to raise money.
Yes, but the truly revolutionary change, according to the source, was explicitly allowing an SV to be financed, either in whole or in part, by any form of loan or borrowing.
Any form of loan. Wasn't that restricted before?
It was, generally. Before 2022, loan financing was often seen as restricted, something that had to be merely ancillary to issuing securities. Now, direct substantial loan financing is clearly permitted, no ambiguity.
And what's the impact of that?
Well, it makes the SV a far more practical and efficient vehicle for transactions that are commonly financed by loans. Think about certain types of trade finance or specific debt restructurings. The SV is now a much better fit.
Okay, here's where it gets really interesting for me, and you touched on convergence. Active management. My understanding was always that SVs were generally sort of passive vehicles. They just whole assets pass through the cash flows based on a preset structure. Did the 2022 law change that fundamental aspect?
Yes, absolutely. And this is another major point where the SV starts looking more like an AIF in function. The 2022 law introduced a really pivotal exception. It now permits active management of the securitized portfolio if two specific conditions are met.
Okay. What are the conditions?
First, the portfolio being managed must consist only of debt securities, financial debt instruments, or receivables. So it's limited to debt-like assets.
Right. Debt only. And the second condition?
The second condition is that the financial instruments issued by the SV cannot be offered to the public. They have to be privately placed.
So active management of a debt portfolio is okay as long as the funding comes via private placement.
Exactly. And the source explains the clear why behind this change. It was specifically designed to attract actively managed credit strategies to Luxembourg, particularly things like collateralized loan obligations, CLOs, and collateralized debt obligations, CDOs.
The CLO market.
Yes. These structures inherently involve active trading and management of the underlying debt portfolio. Before this change, Luxembourg wasn't really a top domicile for these complex structures. They often use fund structures elsewhere. Now, the SV can accommodate them, allowing it to directly compete with AIFs in the private credit space for these specific, actively managed strategies, provided they stay out of the public domain.
That definitely feels like a direct challenge to certain AIFs use cases, especially in private credit. Let's talk about the core features that make SVs so structurally sound, particularly for complex deals. You mentioned compartmentalization and bankruptcy remoteness. They sound incredibly powerful.
They really are the backbone of the SV's structural integrity. And critically, as the source emphasizes, they benefit from statutory validation under the securitization law itself. That's key.
Statutory validation, meaning the law explicitly backs them up.
Precisely. Take compartmentalization. This allows a single SV legal entity to create multiple legally segregated compartments or silos within itself.
Like having separate businesses operating under the same legal umbrella.
Exactly like that, but with really powerful legal ring fencing built in. The key legal effect, which is reinforced by the securitization law, is that the assets within one specific compartment are legally distinct and separate from the assets of all other compartments, and also from the SV's general assets, if it has any.
So creditors of compartment A can't touch assets in compartment B.
That's exactly right. Claims by investors or creditors who have invested in or perhaps lent to one specific compartment are strictly limited to the assets within that particular compartment. They have absolutely no recourse against the assets of other compartments or the general estate of the SV. And creating a compartment is typically just an internal management decision, assuming the articles allow it, so it's administratively quite flexible. Plus, each compartment can even be liquidated independently of the others.
That level of legal separation within one single entity is remarkable. It sounds like a problem in one compartment genuinely can't cause a domino effect across the whole SV structure.
That's the fundamental intent, yes. And the law specifically backs this up, which links directly to the concept of bankruptcy remoteness. The securitization law provides that crucial statutory validation for key contractual clauses that reinforce the separation and protect the SV from premature insolvency. The source highlights two main types of clauses here.
Which are?
Limited recourse clauses and non-petition clauses.
Okay, can you explain those in a bit more detail? What does limited recourse mean in this context?
Limited recourse clauses are provisions written into the contracts where investors or creditors explicitly agree that their right to payment or their right to recovery if things go wrong is strictly limited to the assets of the specific compartment or the specific pool of assets their claim relates to.
So if those assets aren't enough to pay them back fully,
then that's it. They simply cannot claim against any other assets of the SV. Their recourse is contractually and legally limited to that designated pool.
Okay, makes sense. If you invest in compartment A notes, you can only get paid from compartment A's assets. What about non-petition clauses?
Non-petition clauses are where investors and creditors contractually commit not to initiate bankruptcy, insolvency, or similar collective proceedings against the SV entity itself.
Why is that so important?
It's vital to prevent, say, a single disgruntled creditor from potentially collapsing the entire structure through an insolvency filing. That could unfairly prejudice all the other investors or creditors who are relying on the structure continuing to operate so they can receive their payments according to the agreed-upon waterfall distribution.
Right. It protects the integrity of the whole deal structure for everyone else involved. So having the securitization law explicitly export these types of clauses gives them a much higher level of enforceability and legal certainty than just having them purely in a contract somewhere.
Absolutely. The source really emphasizes the statutory backing. It provides a higher degree of legal certainty, which is incredibly highly valued in structured finance, especially when you're anticipating potential stress scenarios or maybe future restructurings.
And AIFs, can they use similar clauses?
Yes, AIFs can and often do use similar contractual provisions in their agreements. But the dedicated legal foundation, specifically within the securitization law for SVs, is often seen by practitioners as providing superior, more robust legal backing for achieving true ring fencing and bankruptcy remoteness. It's designed for it.
That makes a lot of sense. Now, despite all this power and flexibility, you mentioned earlier that SVs are most often unregulated. That sounds like a huge advantage. What are the specific triggers that would actually require an SV to get CSSF supervision?
This is another key strategic point, absolutely. An SV is only subject to prior authorization and ongoing prudential supervision by the Luxembourg financial regulator, the Commission de Surveillance du Secteur Financier, or CSSF.
Right.
If it issues financial instruments to the public and does so on a continuous basis, both conditions have to be met.
Okay, so public and continuous are the magic words here. How does the source define those terms? The 2022 law helped here.
Yes, the 2022 law brought welcome clarity. An issuance is considered to be on a continuous basis if the SV makes more than 3 public issuances of financial instruments per financial year. And that's counted across all of its compartments combined.
Okay, more than 3 public issues a year. And what counts as to the public?
An issuance is considered to the public only if it meets all 3 of the following conditions cumulatively. This is really important.
All 3. Okay, what are they?
1, it must not be addressed solely to professional clients, as defined under the financial sector law, which largely aligns with the MiFID II definition. 2, the denomination of the instruments must be less than 100,000 euros. And 3, it must not be distributed via a private placement arrangement.
Wait, so you have to tick all 3 of those boxes simultaneously for it to be considered an issuance to the public?
Exactly. You have to fail all 3 tests, essentially.
Yeah.
This structure provides a very clear, very practical safe harbor for staying unregulated.
How so?
Well, if you fail to meet any one of those conditions, for example, if you only target professional investors, or if the minimum denomination of your notes is 100,000 euros or more, or if you explicitly structure the distribution as a private placement.
Then you're not public.
Exactly. Then you are not considered to be issuing to the public for the purposes of triggering CSSF supervision under the securitization law. This is precisely why the vast majority of SVs used in sophisticated institutional transactions remain unregulated by the CSSF, and that contributes significantly to their speed and their cost efficiency compared to regulated structures.
That's a really clear, bright line test. What about marketing these unregulated SV instruments then? If AIFMD doesn't apply, how is that governed?
Good question. For unregulated SVs, the marketing doesn't fall under AIFMD rules. Instead, it's governed by the EU prospectus regulation.
Okay, the prospectus regulation.
Yes. So this means that if you intend to make an offer of securities to the public within the European Union, you would typically need to prepare and publish a full, detailed prospectus, which can be quite burdensome.
Unless there are exemptions, maybe like the ones we just talked about for avoiding CSSF supervision.
Precisely. The key exemptions under the prospectus regulation align perfectly with the triggers for avoiding CSS supervision. Offers that are made only to qualified investors, which is a category that largely overlaps with the professional client's definition.
Right.
Or offers where the minimum denomination of the securities is 100,000 euros or more are exempt from the requirement to publish a prospectus.
So the same thresholds, basically.
Exactly. So by structuring SV transactions as private placements targeting institutional qualified investors, or by issuing high denomination notes, 100,000 euros or more, promoters can effectively bypass both CSSF prudential supervision and the burden of preparing a full public prospectus. This alignment is a core part of the SV's appeal for efficient, targeted capital raising. That really gives us a comprehensive picture of the SV framework then. Its core purpose of risk transformation, its statutory flexibility in form and financing, those powerful segregation features like compartments and statutory bankruptcy remoteness, and its strategic positioning as often unregulated, all driven by the specific securitization law. Now, shall we transition to the very different universe of the alternative investment fund, which operates under a fundamentally different philosophy and regulatory regime shaped primarily by AIFMD?
Okay, let's shift gears to the AIF world. The source presents this as a framework that really came out of the post-financial crisis regulatory push. It's harmonized across Europe, and it seems primarily focused on regulating the manager, not necessarily the fund itself all the time. How does AIFMD actually define an AIF, and what's the crucial role of this AIFM?
You're right. The definitions under AIFMD are quite functional and broad. They're designed to capture a wide range of structures based on what they do, not just their legal form. An AIF is defined essentially as any collective investment undertaking.
Collective investment undertaking. There's that phrase again.
Exactly. Any collective investment undertaking that raises capital from a number of investors with the intention of investing it according to a defined investment policy, all for the benefit of those investors. The only main exclusion is that it can't be a UCITS fund.
So the key elements are collective investment undertaking and raising capital for that purpose.
Precisely. It's fundamentally about pooling capital from multiple investors to invest it together. And that contrasts directly, as we've discussed, with the SB's core purpose of risk transformation. And central to this whole AIFMD framework is the alternative investment fund manager, the AIFM.
The AIFM, right?
This is the legal person or entity whose regular business is managing one or more AIFs. The AIFM must perform, at a minimum, the core functions of portfolio management and risk management for the AIFs it manages.
So the AIFM isn't just like an administrator or a service provider. They are the engine, really, driving the investment strategy and managing the risks involved.
Precisely. They are central. And the regulation, as you said, is primarily focused on this manager figure. As the source highlights, the AIFMD framework regulates and supervises the AIFM very comprehensively. The CSSF here in Luxembourg authorizes and oversees AIFMs on pretty much everything: their initial capital, their organizational structure, governance, risk management frameworks, conduct of business rules, reporting obligations, even remuneration policies.
Wow. Okay. So the regulator is keeping a very close eye on the people running the fund.
They are. The main objectives are investor protection and monitoring systemic risk across the financial system.
And the source mentions there are different categories of AIFM based on size. How does that work?
Yes, there are two main categories in Luxembourg, and it's based on the value of the assets under management, the AOM. A manager requires full CSSF authorization as an authorized AIFM if their total AOM exceeds certain thresholds. Those are 100 million euros if they manage AIFs that use leverage,
Okay.
or 500 million euros if they manage AIFs that are unleveraged and have no redemption rights for the first 5 years.
Right. Higher threshold for unleveraged, locked-up funds.
Exactly. These fully authorized AIFMs, they're subject to the full, detailed requirements of the AIFMD regime. And crucially, they are the ones eligible for the European Marketing Passport.
The passport. Got it. And what about the smaller managers below those thresholds?
Managers below those AOM thresholds can operate under a lighter regime. They register as a registered AIFM.
Registered, not authorized.
Right. It's a lighter touch. They must register with the CSSF, and they have to report certain data, mainly for systemic risk monitoring purposes. But they're exempt from most of the really prescriptive organizational and conduct rules that apply under full AIFMD. The key drawback, though, is that registered AIFMs do not benefit from the AIFMD marketing passport.
Okay, no passport for the smaller registered guy.
Correct. And the source makes an important point here. Even if an AIF itself isn't a regulated product, think of a RAIF, which we'll get to, or just a simple AIF set up as an SCSP, it still has a link to regulatory supervision because it must appoint an AIFM, even if it's only a registered AIFM below the thresholds. This mandatory manager oversight layer is a fundamental difference compared to a truly unregulated SV, which might have no direct or indirect link to CSSF supervision at all.
That makes perfect sense. The supervision is always there on the AIF side, either directly on the fund itself or indirectly through that mandatory manager appointment. Now let's get to the really big selling point for AIFs that the source emphasizes quite strongly, the marketing passport. How does that actually unlock market access across Europe? It sounds incredibly valuable.
It is arguably the single most powerful feature of the entire AIF framework, especially for managers who are targeting professional investors across different European countries. Essentially, it allows a fully authorized AIFM based in one EU member state like Luxembourg to market the units or shares of any EU AIF. It manages to professional investors throughout the entire European Economic Area, the EEA, and it does this based on just a single authorization from its home regulator.
Wow. So if I'm a Luxembourg authorized AIFM, I can use that authorization to market my Luxembourg or maybe even an Irish or French AIF that I manage.
Exactly.
Into, say, Germany, Italy, Sweden, Spain.
Okay.
Just by notifying the regulators through the proper channels.
That's precisely how it works. It streamlines the process immensely. Think about the alternative. Before AIFMD or outside the passport system, you'd have to comply with potentially complex, very costly, and often significantly different national private placement regimes, or NPPRs, in each individual country you wanted to market in.
Which sounds like a nightmare.
It could be, yes, very burdensome. The AIFMD passport creates a harmonized pathway. The process, as outlined in the source, is relatively straightforward. The authorized AIFM notifies its home regulator, so the CSSF here in Luxembourg. They provide details about the AIF they want to market and list the specific member states where they intend to market it.
Okay.
The CSSF then reviews this notification package. They have 20 working days to do so. If the file is complete and compliant with AIFMD rules, the CSSF transmits it electronically to the competent authorities in those target host member states.
Well, then.
Once the CSSF informs the AIFM that this transmission has successfully occurred, the AIFM can begin marketing to professional investors in all those listed countries.
That's a significant reduction in complexity, bureaucracy, and cost compared to dealing with dozens of different national rulebooks.
It's truly transformative for pan-European fundraising efforts. The source points out very clearly that this access to the entire EEA market is the key strategic trade-off. It's why managers are willing to accept the full regulatory burden and associated costs of becoming an authorized AIFM. For strategies that really rely on broad distribution to institutional investors across Europe, the passport is often the deciding factor that justifies choosing the AIF route, despite the higher compliance costs and complexity compared to, say, an unregulated SV. It genuinely creates a true internal market for professional fundraising.
Okay, that's a powerful incentive. What about the assets AIFs can hold? Is it as flexible as the SV? And can you clarify those different types of AIFs mentioned in the source? The SIF, SICAR, and RAIF, what are they?
Generally speaking, yes, AIFs are also very flexible regarding the types of eligible asset classes they can invest in, much like SVs in that respect. If you set up a simple AIF structure, like using the SCSP form.
The partnership form?
Yes, the special limited partnership. That structure isn't inherently restricted by the AIFM law itself in terms of what it invests in or how much it needs to diversify its portfolio. However, Luxembourg provides what the source calls a powerful toolbox of specific product laws for AIFs. These laws layer additional rules and requirements on top of the basic AIFM framework.
But they also offer benefits.
Exactly. They also offer specific benefits, perhaps a particular regulatory status, or they might be designed to target different types of investors more effectively.
So the basic AIF structure is flexible on assets, but choosing a specific type of regulated or semi-regulated AIF adds particular characteristics and rules.
Precisely. The source highlights 3 key product types from this toolbox. First, there's the Specialized Investment Fund, or SIF. A SIF is a regulated AIF product. It requires specific approval from the CSSF for the fund structure itself, in addition to needing an authorized AIFM. It's quite flexible in that it can invest in basically any asset class. However, it is generally subject to risk-spreading rules. Typically, a SIF is limited to investing no more than 30% of its assets in a single asset, or perhaps a group of connected assets.
So diversification is built in?
Generally, yes. It's designed for professional and well-informed investors, which is a slightly broader category than just professional clients under MiFID.
Okay, so SIF is regulated, diversified, for well-informed investors. What's the SICAR then?
The investment company in risk capital, or SICAR, is also a regulated AIF product, and it also requires CSSF approval. However, it has a very specific investment focus mandated by its law. It must invest in risk capital.
Risk capital meaning?
Meaning things like private equity and venture capital investments, direct equity stakes, essentially. The key feature of a SICAR, and why it's attractive for PE and VC strategies, is that it is explicitly exempt from those risk-spreading rules that apply to SIFs.
So it can concentrate its investments.
Yes. It allows for highly concentrated investments, potentially putting a large portion of its capital into a single portfolio company, which is often essential for control-oriented private equity strategies. Like the SIF, it's also targeted at professional and well-informed investors.
Okay, so SICAR is regulated, allows concentration, but specifically for PEVC-type risk capital investments. What about the RAIF? That sounds different.
The Reserved Alternative Investment Fund, the RAIF, is a more recent innovation introduced to kind of bridge the gap between the fully regulated products and the unregulated structures. It's often described as a hybrid. Crucially, the RAIF vehicle itself is not directly supervised by the CSSF.
Not supervised. How does that work?
This provides a significant speed-to-market advantage compared to the SIF and the SICAR, because you avoid that fund-level regulatory approval process, which takes time. However, and this is the key, a RAIF must appoint a fully authorized AIFM.
So the manager must be fully regulated.
Exactly. This ensures there's still regulatory oversight, but it's indirect, focused entirely on the manager rather than the fund product itself. In terms of investments, a RAIF can choose electively to adopt the investment and risk diversification rules of either a SIF or a SICAR.
So it can mimic either a SIF or a SICAR profile.
Yes, it allows flexibility in investment strategy. You can have a diversified AIF SIF type or a concentrated AIF SICAR type, but under this faster, indirectly supervised structure. It's also targeted at well-informed investors.
Okay, so the Luxembourg Toolbox really offers a spectrum of choices then.
Right.
You could have a completely unregulated partnership like an SCSP AIF for maximum flexibility.
Right, relying only on the AIFM registration or authorization.
Or you could go for RIF, which gives you speed plus the credibility of a fully regulated manager. Or you could opt for the fully regulated SIF or SICAR, which might appeal more to certain types of highly regulated institutional investors, but takes longer to set up.
Exactly. It provides promoters with a range of options depending on their specific strategy, the regulatory appetite or requirements of their target investors, and of course the required speed of launch for the project.
Now, the source mentions that AIFMD2 is on the horizon, or actually it's here now in terms of the directive being published.
Yep.
How does that impact this whole comparison between SVs and AIFs?
This is very significant, yes. As you say, it reinforces that convergence trend we've been seeing. The directive and Directive EU 224927, which is known as AIFMD2, was published on March 26, 2024. EU member states now have until April 16, 2026 to transpose it into their national laws.
So changes are coming into effect around spring 2026.
That's the timeline, yes. It introduces several changes across the AIF-MD framework, but the most relevant one for this particular deep dive, comparing SVs and AIFs, is undoubtedly the creation of a dedicated, harmonized regime specifically for loan originating funds, or LOFs, within the AIF framework.
Loan origination funds. Now, as we discussed earlier, loan origination, especially in private credit, has often used the SV structure, right? Because of its flexibility.
Precisely. Private credit strategies, especially those involving the origination of new loans rather than just buying existing ones, have often found the flexible and often unregulated SV structure attractive, particularly using the SCSP partnership form. AIFMD2 is now creating a specific, regulated, and importantly, passportable pathway for these exact strategies within the AIF ecosystem.
So managers doing loan origination will soon have a clear choice.
Exactly. Post-April 2026, they'll have a clearer choice. Continue using a flexible SV, maybe for specific bilateral loan deals or club deals where a passport isn't needed, or move to a regulated AIF-LF structure which offers the marketing passport across Europe.
What are some of the specific rules that will apply to these new AIF-LFs, according to the source? Does it add complexity?
It does add specific rules and complexity compared to an unregulated SV, yes. The source details several key requirements. AIF LOFs will be subject to specific leverage limits, which differ slightly depending on whether the fund is open-ended or closed-ended.
Okay, leverage caps.
Yes. There will also be a mandatory risk retention requirement, often called skin in the game. The manager, or perhaps a related entity, must retain a net economic interest of at least 5% in the nominal value of each loan originated by the fund.
5% skin in the game. Interesting.
There are also concentration limits. For example, generally, an AIF LOF cannot grant loans where the borrower is a financial undertaking, another AIF, or UCIs, if that single loan exceeds 20% of the AIF's capital.
Right, limiting exposure to single financial counterparties.
Exactly. Furthermore, the rules generally require that AIFs whose investment strategy is primarily focused on originating loans must be established as closed-ended funds, or if they are open-ended, they need to implement particularly robust and effective liquidity management tools.
So definitely more operational and regulatory constraints than you'd find in a typical unregulated SV doing lending. But the benefit is clear.
The benefit is the AIFMD passport. That's the big prize. Post-April 2026, an AIF OOF that is managed by a fully authorized AIFM will be able to leverage that passport to market its units or shares to professional investors right across the EEA, specifically for the purposes of its loan origination strategy.
That feels like a major shift in the landscape for private credit funds.
It is. It offers private credit managers a clear, harmonized, regulated route for pan-European fundraising specifically for their origination activities. This will likely draw significant activity, especially for larger funds seeking broad European distribution, into the AIF framework activity that might previously have gone to SVs.
So SVs might then become more focused?
Potentially, yes. SVs may then focus more on their inherent strengths for smaller, more bespoke, perhaps geographically limited loan transactions where the passport isn't the essential driver, or where the specific features of the securitization law, like statutory bankruptcy remoteness, are paramount.
It really sounds like AIFMD2 is deliberately positioning the AIF structure as the go-to regulated passportable structure for certain strategies like loan origination that previously might have defaulted to the SV primarily for flexibility reasons.
That's a very accurate reading of the trend highlighted in the source, yes. AIFMD2 is definitely extending the reach and the relevance of the AIF framework into areas that were previously dominated more by SVs. And the source also briefly mentions other AIFMD changes that contribute to this overall deepening of the AIF regulatory regime, things like harmonized rules for liquidity management tools, LMTs, for open-ended AIFs, codified requirements for substance, like needing 2 resident senior managers for the AIFM, and clearer rules around delegation of functions, all pointing towards a more robust but also more complex regulated AIF world.
Okay, so we have these 2 really sophisticated tools available in Luxembourg. We've got the flexible, often unregulated SV, built fundamentally for risk transformation and benefiting from specific statutory features. And then we have the regulated, manager-centric AIF, designed for collective investment and offering that powerful market access via the passport.
How does someone actually make the strategic decision between them in practice? What does the source say about the practicalities?
Well, the source stresses that the choice really moves beyond just the high-level legal definitions. It requires a much more granular analysis of the practical realities involved in setting up and running each structure. It's about the operational aspects, the documentation involved, the ecosystem of parties you need to engage, the costs, the timelines, the capital needs, and most importantly, aligning all of that with the specific strategic goals of the promoter or originator.
So really digging into the details. Exactly. What are the underlying assets or risks? Who are the target investors? What's the intended distribution strategy? Just a few investors or broad marketing? And critically, what's the tolerance level for regulatory complexity and the associated costs?
Okay, let's break down some of those practicalities then based on the source, starting with maybe the how and the what, who are the typical parties involved, and what does the documentation suite look like for each?
Right. The ecosystem of parties involved is significantly different, and it really reflects the underlying regulatory model of each structure. For an SV, especially an unregulated one, the setup tends to be leaner. You'll typically have the originator who's transferring the assets or risks, or maybe an arranger putting the deal together. You'll definitely need legal advisors. You'll need a corporate service provider for the day-to-day administrative functions of the SV entity, and an auditor. You might also have some specialized agents involved, depending on the transaction, like a calculation agent to work out payments or a paying agent to distribute them.
Okay. What about a custodian or the CSSF?
A custodian and the CSSF are only mandatory if the SV triggers those conditions we discussed earlier, issuing financial instruments to the public on a continuous basis, and therefore becomes CSSF supervised. For most unregulated SVs, they aren't required players.
So potentially fewer mandatory players, keeping it simpler for an unregulated SV. How does the AIF compare?
The AIF ecosystem, particularly when you're dealing with an authorized AIFM and its funds, is generally much more extensive, and it's built around engaging regulated service providers. You'll have the promoter or initiator who conceives and sets up the fund structure. You'll need legal advisors, of course. You absolutely must appoint an AIFM, which could be an in-house management team if the promoter is large enough, or more commonly, a third-party management company service provider. The Manco, exactly. And then you require a set of mandatory, often CSSF-supervised service providers. You must have a depositary who's responsible for oversight functions and the safekeeping of the fund's assets. You must have a central administrator for handling fund accounting, NAV calculation, transfer agency, and investor relations, and you need an auditor. Plus, the CSSF is always involved in the AIF world, at least indirectly, because it supervises the AIFM, and it often directly supervises the fund product itself if it's a regulated type like a SIF or a SICAR.
That clearly adds several mandatory layers of required service providers and inherent regulatory oversight on the AIF side that the basic unregulated SV just doesn't have. How about the documentation itself? What are the key documents for each?
The documentation suite also reflects this fundamental difference in structure and purpose. For a typical SV transaction, the central piece of documentation is usually the issuance document. Now, this could be a formal prospectus if it happens to be a public offer that requires one under the prospectus regulation.
Which is rare, as we discussed.
Which is rare for SVs, exactly. More commonly for the typical private placement SV, it will be an offering circular or a private placement memorandum, PPM. This main document is then paired with the SV's constitutional documents, its articles of incorporation if it's a company, or maybe management regulations if it's a fund. And then you have key ancillary agreements detailing things like how the underlying assets are serviced, the servicing agreement, the security package, if any, and the terms for investors subscribing to the instruments, subscription agreements.
Okay, focused on the issuance and the assets.
Yeah.
And for an AIF, what are the core documents there?
For an AIS, particularly one set up using the common partnership structures like the SCSP, the absolute core legal document defining the structure and the relationship between the manager and the investors is the Limited Partnership Agreement, or LPA.
The LPA, that's central in private funds.
It is. If the AIF is a corporate structure, then the articles of incorporation serve that role. The marketing document is usually also called a private placement memorandum or an offering memorandum, similar to the SV in name, but focused on the fund's strategy and terms. But critically, the operational framework of an AIF is really defined by those mandatory service contracts we mentioned, the AIFM agreement setting out the manager's role and fees, the depository agreement detailing the depository's duties and liabilities, and the central administration agreement covering the admin functions. These contracts are central to how the AIF actually functions day-to-day within the required regulatory regime.
That really highlights how the AIF documentation is heavily focused on embedding those required service provider relationships and the regulatory oversight structure. What about negotiation then? When people are putting these deals together, what are the key clauses or points that people tend to focus on, or maybe spend the most time debating in these different types of documents?
Yeah, that's a great question. The focus of the negotiation really aligns directly with the primary purpose and structure of each vehicle. For SVs, because they are typically built for a specific transaction involving the transfer of defined risks and cash flows, the negotiations tend to be highly bespoke and very asset-centric. The heaviest negotiation usually happens around mechanics of that specific transaction as captured in the issuance documents.
Like the waterfall clause you mentioned, is that a big one?
Exactly. The waterfall clause is perhaps the most intensely negotiated part of an SV deal. It specifies the precise priority order in which the cash flows generated by the underlying assets are distributed. Who gets paid first? The swap counterparty, senior note holders, mezzanine, equity, paying the SV's expenses. Negotiating the waterfall is absolutely fundamental to allocating the risk and the return among the various parties involved in the securitization. It dictates who bears the first loss if things go wrong.
So it's all about slicing up the cash flows from the assets and determining who gets paid first, second, third.
Right.
Especially if there isn't enough money generated to pay everyone in full.
Precisely. And the other critical clauses in SVs that see heavy negotiation are those ones we discussed related to achieving bankruptcy remoteness, particularly the limited recourse clauses, the non-petition clauses, and any related subordination provisions. Because their effectiveness and their enforceability are so vital to the overall integrity and rating of the structure, their exact wording is scrutinized incredibly carefully. Lawyers pore over these to ensure they achieve the intended legal effect and benefit from that statutory validation under the securitization law. They really are the legal foundation of the structure's robustness against insolvency.
Okay, so SV negotiation sounds deeply embedded in the nitty-gritty specifics of the asset pool, the cash flows, and the structural protections for that particular deal. How does that compare to a typical AIF negotiation? Is it different in focus?
Yes, it's generally quite different in focus. AIF negotiations tend to be more manager and investor relationship focused, and they often follow more established market conventions, especially for institutional grade funds. The main focus is usually on the terms within the LPA for partnerships and the PPM. Key negotiated clauses typically include the economics, the management fees, and the performance fees or carried interest.
The 2 and 20 model, or variations.
Exactly. The classic 2 and 20, including all the details around how it's calculated, like the hurdle rate the manager needs to achieve before earning performance fees, and any clawback provisions requiring the manager to return fees if subsequent performance drops. That's always heavily negotiated.
Right. How the manager gets paid and how their interests are aligned with the investors. What else is key in AIF talks?
Other key areas are usually around governance and investor rights. This covers things like key person provisions, what happens if the main fund manager leaves. It includes the powers and composition of the Limited Partner Advisory Committee, the LPAC, which provides investor oversight. And it covers the information rights and consent rights that investors have over major fund decisions. Investor eligibility criteria and the associated confirmations are also crucial to get right for compliance. And finally, the terms around the AIFM's ability to delegate functions to other parties and who bears a liability if something goes wrong with that delegation are also typically subject to negotiation.
Okay, so if the SME negotiation is, as you suggested, maybe like fine-tuning a very specific complex machine built for a single task, the engine analogy, is the AIF negotiation maybe more like setting the operating rules and the relationship terms for a much longer-term journey? Like building a reliable vehicle platform for broader travel, involving a group of people, the manager and investors, under a set of agreed rules.
That's actually a pretty good analogy, yes. I think that captures the difference quite well. The SV is often very deal-specific, asset cash flow driven, focused on the mechanics of that transaction. The AIF negotiation is more about establishing a durable platform, defining the rules of engagement between the manager and the investors for executing a collective investment strategy over a longer period, all within a regulated framework with mandatory service providers.
Okay, that makes sense. Now let's get to the really practical stuff, the when and how much. Timeline and costs. These are often the make or break factors in choosing a structure. How do they compare between SVs and AIFs based on the source?
This is where the contrast is often most stark, and it can be absolutely decisive in practice. For an unregulated SV, the timeline is typically the fastest, significantly so, since there's no requirement for prior CSSF authorization or approval of the vehicle itself.
Right, no regulatory waiting time.
Exactly. The vehicle can be incorporated and become legally operational in a matter of weeks, sometimes even days for simpler structures. The main limiting factor on the overall timing is almost entirely the time needed to negotiate, draft, and finalize the specific transaction documentation between the parties involved.
That speed must be a major competitive advantage for certain types of deals.
Absolutely. For transactions where swift execution is critical, maybe seizing a market opportunity or meeting a specific deadline, that speed is invaluable. Now, for an AIF structure, the RAIF, the Reserved Alternative Investment Fund, generally offers the quickest path for getting a fund vehicle up and running.
Because the RAIF itself isn't CSSF approved.
Precisely. Since the RAIF itself isn't directly supervised by the CSSF, its launch timeline is also driven primarily by the documentation time, provided that the mandatory authorized AIFM is already in place or perhaps being set up concurrently. A RAI does need to be formally incorporated by a notarial deed and then registered with the Luxembourg Trade and Companies Register, RCS, within 5 business days of that deed, which is remarkably fast for establishing a fund-like structure with regulatory links.
Still pretty quick for a fund structure then. What about the fully regulated AIFs, the SIFs and SICARs? They take longer.
Yes, the regulated AIFs, the SIFs and SICARs, require full prior CSSF approval for the fund structure itself before they can launch. This regulatory review and approval process inevitably adds time to the setup. Promoters should generally anticipate a timeline of around 4 to 5 months, maybe a bit longer sometimes, from the point where they submit a complete and high-quality application file to the CSSF until they actually receive the green light, the approval.
4 to 5 months. Okay, and what if you don't have an AIFM already and need to establish a brand new authorized AIFM as well?
Well, that's generally the longest path. Obtaining full CSSF authorization for a new AIFM entity is a very detailed and thorough process. It involves scrutinizing the structure, the capital, the shareholders, the governance, the policies, the people. That can typically take anywhere from 6 to 9 months, sometimes even longer, depending on the complexity of the proposed setup and the quality and completeness of the application file submitted to the CSSF.
6 to 9 months just for the manager authorization. Wow.
Yes. So when speed to market is the absolute #1 priority for getting a transaction done, the unregulated SV typically has a very significant timing advantage over all the AIF structures, even over the relatively quick RAIF.
Okay, that's clear on timing. How about costs? Both the initial setup costs and the ongoing running costs.
Here again, the unregulated SV generally comes out significantly more cost-effective, especially on the setup side. They typically have simpler administrative and legal setup requirements compared to a regulated fund. And crucially, you avoid the substantial upfront costs associated with appointing mandatory service providers like a depositary, and you avoid the initial regulatory fees associated with obtaining CSSF authorization for the fund or the manager.
Right, no depositary fees, no CSSF application fees for an unregulated SV.
Exactly. AIFs, particularly those requiring a fully authorized AIFM and a mandatory depositary, face considerably higher initial legal, advisory, setup, and regulatory costs. It's just a higher hurdle to get started.
So higher setup costs for AIFs. What about keeping them running year after year, the ongoing cost?
The higher cost base generally continues with the ongoing annual expenses for AIFs. There are recurring CSSF supervision fees. The source mentions, for example, that for an authorized AIFM alone, the annual CSSF fee can range somewhere between 15,000 and 25,000 euros, and that's before any additional fund-level fees if the AIF product itself is regulated, like a SIF or SICAR.
Okay, significant regulatory fees.
Yes. Then you have the ongoing fees for the AIFM service itself, the mandatory depositary fees, the central administration costs, and AIFs often face more complex and therefore more costly audit and regulatory reporting requirements mandated by AIFMD and related regulations. Unregulated SVs, in contrast, tend to have a much leaner ongoing cost profile, primarily covering their basic corporate administration, accounting, and standard audit fees.
So if cost efficiency, maybe especially for smaller deals or transactions with a limited lifespan, is a major driver in the decision, the unregulated SV seems to have a pretty clear financial advantage.
Absolutely. That's often a key factor driving the choice towards an SV for certain types of transactions.
What about capital requirements? Does one structure require more upfront capital than the other?
Yes, there's a significant difference here, too. For SV set up as companies, the minimum capital requirements are generally based on standard Luxembourg corporate law, for instance, 30,000 euros for an SA or SCA, and 12,000 euros for an SARL. And if the SV is set up as a securitization fund without legal personality, there's actually no statutory minimum capital requirement at all.
So relatively low capital needed for an SV. How about AIFs?
AIFs generally face substantially higher capital requirements, especially on the regulated side. A regulated fund product like a SIF needs to reach a minimum net asset value, NAV, of 1.25 million euros, typically within 12 months of its authorization.
€1.25 million NAV for a SIF.
Okay. And an authorized AIFM itself needs to have an initial minimum capital of 125,000 euros, plus it needs to hold additional capital based on a percentage of the AOM it manages above a certain threshold, although that additional amount is subject to a cap.
Right, so significantly more capital tied up in the AIF structure, both at the fund level potentially and definitely at the manager level, if it's fully authorized.
Correct. So if you summarize those practical points from the source speed, cost, and capital requirements, if those factors are paramount, the unregulated SV often holds a clear edge.
Okay. And combining all these factors, the purpose, the features, the regulation, the practicalities, leads us directly into the strategic use cases, right? The why and when to choose one structure over the other, as effectively summarized in the source's comparative analysis. Based on that source material, when should someone lean towards choosing a securitization vehicle?
According to the analysis in the source, you should generally lean towards choosing an SV when your primary objective is a bespoke, perhaps quite complex, single-asset financing deal, or maybe financing a specific limited portfolio of assets or risks. It's often ideal for structuring transactions like repackaging existing bonds, financing specific large assets like aircraft or real estate portfolios, or creating specific synthetic risk exposures for investors.
Okay, bespoke and specific deals.
Yes. It's also presented as the go-to structure now for those actively managed debt portfolios like CLOs or CDOs, thanks to the 2022 reform, provided that the instruments issued by the SV are intended for private placement to a select group of sophisticated institutional investors, not the public.
Right, the active management capability, but only for private deals.
Exactly. Also, if your target investor base is small, maybe already pre-identified, and they don't specifically require the full AIFMD regulatory stamp as a mark of quality or for their own internal reasons, then the SV often fits well. And most crucially, the source emphasizes, choose an SV when speed to market and cost efficiency are the absolute primary drivers for getting the transaction completed, and importantly, when there's no strategic intention or need to broadly market the vehicle's instruments across multiple EU or EEA jurisdictions using a passport.
Okay, so SV for bespoke, fast, cost-effective, privately placed deals without a need for the EU passport. When then does the alternative investment fund become the more compelling choice, according to the source?
The source indicates that an AIF becomes the better, often necessary choice when the primary objective is raising capital from a diverse base of professional investors located across multiple EU or EEA countries. This is where the unique power of the AIFMD marketing passport becomes indispensable for achieving efficient, streamlined access to that entire European institutional market.
So if broad European distribution is key, AIFs is the way.
That's the main driver, yes. It's also generally more suitable when the goal is to build a scalable fund platform, a structure that will make multiple investments over time under a consistent setup and brand, rather than just a single deal. Also, if the regulated status either of the AIFM alone, as with the RAIF, or of the fund itself, if choosing a SIF or SICAR, is perceived as a key selling point, or maybe even a mandatory requirement for the target institutional investor base, like some pension funds or insurers, then the AIF route is preferred.
The regulatory badge matters sometimes.
It can, definitely. And looking ahead, the source clearly flags that post-April 2026, if the strategy is specifically a loan-originating fund that requires that pan-European distribution capability via the passport, then the new regulated AIF LO-FIT structure will likely be the natural and possibly required choice. So this detailed comparison of the practicalities and strategic uses really brings us back full circle to the evolving relationship between these two powerful structures and how the strategic decision looks, especially in light of future regulatory changes like AIFMD2.
Yeah, it's definitely clear from the source that the picture isn't static at all. You've got the 2022 SV reform making SVs more fund-like in some ways, and then the upcoming AIFMD2 making AIFs more capable in traditional SV areas. It really highlights that convergence trend.
Absolutely. We're clearly seeing SVs adopting structural forms like the SCSP partnership that were previously almost exclusive territory for AIFs, and they're also being enabled under specific conditions to conduct activities like the active portfolio management of debt, which were historically much more aligned with fund strategies than traditional securitization.
And then on the other side, as you said, AIFs are moving into territory that was traditionally handled mainly by SVs.
Exactly. The creation of that dedicated AIF LOF regime under AIFMD2 is the prime example cited in the source. It brings loan origination, which is a classic securitization activity, fundamentally transforming credit risk firmly into the regulated, passportable AIF framework. This directly positions the AIF LOF as a clear competitor to the SV for private credit strategies, particularly those that are aiming for broad European distribution.
So the frameworks are starting to look more alike structurally in some ways, and they can clearly be used for increasingly similar underlying strategies like private credit. Does that actually make the choice between them simpler, or does it make it harder?
The source suggests it actually makes the choice more nuanced, potentially harder in some ways. Especially after AIFMD2 is fully transposed and effective in 2026, a private credit manager, for instance, will face a more complex decision matrix than they might have faced back in, say, 2021. Well, they could still opt for the unregulated, highly flexible, cost-efficient SV, maybe in an SCSP form, for a specific targeted loan transaction, or perhaps a club deal where speed is paramount and the passport isn't needed. Or they can choose the new AIF LOF structure to gain access to that valuable passport and potentially build a more scalable, regulated platform suitable for pan-European fundraising, but they have to accept the associated higher costs, complexity, and regulatory constraints like risk retention and leverage limits.
So the optimal choice depends even more on the really granular details of the specific strategy, the precise target investor base, and the intended distribution channels.
Exactly. It's really about picking the right legal wrapper based on the specific features and regulatory implications required for that particular objective, even if the underlying assets being managed or the legal form chosen, like an SCSP, might look quite similar on the surface.
It's about the purpose and the regulation more than just the form.
Yeah.
Is the regulatory burden also converging then? Are SVs becoming as regulated as AIFs?
Not necessarily, and this is a really important counterpoint that the source brings up towards the end. While the scope of activities might be converging somewhat, the regulatory intensity remains a key and possibly widening differentiator. The source explicitly notes the ongoing trend of deepening regulatory requirements specifically on the AIF side.
It gives this example.
Yes, as an example, they mention the new CSSF Circular 24856, which becomes effective from January 1st, 2025. This circular imposes quite detailed new requirements specifically for regulated AIFs, like SIFs and SICARs, on how they must handle net asset value, NAV calculation errors, and manage compliance breaches.
Okay, so more rules for the regulated AIFs. What does that tell us in this context?
It illustrates the regulator's continuous focus on enhancing investor protection, operational transparency, and overall rigor within the regulated AIF framework. This ongoing regulatory evolution on the AIF side actually serves to widen the gap in regulatory intensity and operational complexity between a fully regulated AIF, or even a RAIF, with its mandatory link to an authorized AIFM, and a truly unregulated SV. So while they might structurally resemble each other more now or hold similar types of assets, the fundamental difference in the level of regulatory oversight and the associated operational burden remains a critical factor driving the strategic choice between them.
Right, so understanding this dynamic, the convergence in some areas, but the divergence in regulatory intensity, and understanding the specific trade-offs between flexibility and market access and the different regulatory layers associated with each framework, that seems absolutely crucial for anyone trying to make informed decisions in Luxembourg's financial structuring space today.
Absolutely. The source really concludes by reinforcing that Luxembourg offers this incredibly sophisticated toolbox, not just one single solution. The choice is often not just between two entirely separate and distinct vehicles anymore, but frequently between two powerful legal wrappers that can increasingly be applied to similar underlying strategies and even similar corporate forms. The core difference, increasingly, lies in the regulatory approach applied to them and the specific strategic benefits like speed and cost versus passport and regulated brand that are derived from that approach.
It really feels like the choice is becoming more strategic, more dependent on the ultimate objective than ever before.
Precisely. It demands a very clear understanding of those objectives and how each framework aligns with them.
Well, that was a truly insightful deep dive, really unpacking the fundamental differences, the nuances, and the strategic considerations when choosing between Luxembourg securitization vehicles and alternative investment funds, and all drawn directly from the valuable source material we had available. Thank you so much for guiding us through that complex landscape.
My pleasure. It's certainly a dynamic area and, yeah, a crucial one to understand for anyone operating in or advising on structures in Luxembourg.
And to you, our listener, thank you very much for joining us for this deep dive. We really hope this exploration has provided you with a clear understanding of these two key structuring tools, the factors that differentiate them, and ultimately helps you navigate this complex space a bit more easily.
And perhaps as a final provocative thought for you to consider, drawing from the source's conclusion about the future landscape, in a world where these legal structures are becoming more adaptable and the underlying strategies they're used for are converging, how does having a deep understanding of the original legal philosophy that underpins each vehicle, that core idea of risk transformation for SVs versus collective investment for AIFs, how does that become more, not less, essential for selecting the truly right tool for your specific objective? Something to perhaps ponder as this landscape continues to evolve.
Indeed, a very interesting point to end on. Until next time.
This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice.
Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.